Hello traders, and welcome back to Explain the Charts. Today is October 1st, 2025, and we are doing a deep dive analysis on EURUSD, which is sitting at a fascinating crossroads of conflicting fundamental news and technical signals. First, let's break down the major news events driving the market because there is a lot to unpack. The biggest headline right now is the U.S. government shutdown, which is putting significant pressure on the U.S. dollar and providing a tailwind for the euro. This political turmoil in Washington is creating uncertainty, leading investors to sell the dollar. Adding fuel to that fire, we just received a shocking September ADP employment report. The private sector unexpectedly shed 32,000 jobs, a massive miss from the forecasted gain of 51,000, marking the biggest decline in over 2 years. This extremely weak labor market data immediately reinforces the bearish case for the US dollar in the short term. However, the longer-term picture is more complicated. We have diverging monetary policies between the US Federal Reserve and the European Central Bank. While the Fed recently cut rates, futures markets are pricing in more, though Chair Powell has suggested a less aggressive easing cycle. Conversely, the ECB remains dovish, with recent German producer price index data showing a concerning 2.2% year-over-year drop, highlighting deflationary pressures. This fundamental tug-of-war is creating a very dynamic environment, with short-term dollar weakness fighting against a potentially stronger long-term outlook for the U.S. economy compared to the Eurozone. Now, let's see how this narrative is reflected in the price action on our daily chart. Looking at the past several months, we can see a powerful uptrend that began in early 2025. This bullish momentum carried the pair all the way up to a multi-year high of 1.1918 in mid-September. This peak proved to be a major resistance level and the turning point for the trend. Following that high, we saw a sharp reversal and a series of strong bearish candles, taking the price below 1.1700 just last week. This downtrend aligns with news of a resilient U.S. economy at the time and growing concerns over disinflation in the Eurozone. The price has since been trying to find its footing, and this recent bout of dollar weakness has pushed it back up into this consolidation zone. We can clearly see the price has entered a downtrend since that September peak, making lower highs and lower lows. Let's switch to the 1-hour chart to get a closer look at the very recent price action. Here we can see the market's direct reaction to the recent news. The price was grinding lower, but we see a distinct pop upwards, corresponding perfectly with the negative ADP data and shutdown news. This surge took the pair from below 1.1700 to its current trading range around the 1.1730 to 1.1750 area. This 1.1750 level is acting as immediate intraday resistance. Notice how the price has tested this area multiple times in the last 24 hours and has struggled to break through decisively. The momentum appears to be bullish in the very short term, but it is now encountering a significant hurdle. This shows the market is digesting whether the recent dollar weakness is a temporary blip or the start of a new, larger move up. Zooming in even further to the 15-minute chart, we can see this battle at the 1.1750 level in high definition. Price action is choppy, indicating indecision among traders. We see tight consolidation with neither bulls nor bears able to take control. This is typical behavior as the market waits for the next catalyst. Traders are likely waiting for more news on the U.S. shutdown or looking ahead to the next major data release, like the non-farm payrolls report. For now, this chart suggests being cautious until a clear break occurs. A break above the recent highs around 1.1760 would be a bullish signal, while a fall below the support around 1.1710 would be bearish for the short term. Returning to our daily chart, let's summarize the key levels and potential scenarios. From a technical standpoint, the primary trend since mid-September is bearish. For the bulls to regain control, they first need to decisively break the resistance cluster between 1.1750 and 1.1770. If they succeed, the next major upside target would be the 1.1820 level. A break above 1.1820 would invalidate the recent bearish momentum and could open the path for a retest of the major high at 1.1920. On the flip side, the immediate support level to watch is the 1.1710 to 1.1690 zone. A failure to hold this support would reinforce the bearish case and signal a continuation of the downtrend. Below that, further supports are found at 1.1660 and then 1.1615. Long-term forecasts even mention a potential decline toward 1.0330 or parity if U.S. economic outperformance continues and Eurozone weakness persists. So, let's recap the important points. Key resistance levels are 1.1770, 1.1820, and the major peak at 1.1920. Key support levels are 1.1700, 1.1660, and 1.1615. Our short-term bullish scenario, with about a 40% probability, relies on the U.S. government shutdown being prolonged and more weak U.S. data. This would likely push the price to test the 1.1820 resistance. Our short to medium-term bearish scenario, which we see as having a 60% probability, assumes a quick resolution to the shutdown and a return to the underlying theme of U.S. economic resilience. In this case, a break below 1.1700 could accelerate the move down towards the 1.16s. Things to watch for are any developments on the U.S. shutdown, the upcoming non-farm payrolls data, and any statements from Fed or ECB officials. These events will be the catalysts for the next significant move. Please remember, this content is for informational purposes only and is not financial advice. Trading involves risk, and you should always conduct your own research and analysis before making any investment decisions. Thank you for watching Explain the Charts.